Have you ever noticed how a unique, almost magical sense of optimism seems to take over the world during the very last week of the year? People are wrapping up their projects, spending time with family, buying gifts, and looking forward to a fresh start in the new year. But what if this widespread holiday cheer isn't just felt in our homes and shopping malls? What if this exact, brief window of time actually triggers a highly consistent, almost predictable anomaly in the global financial markets? Imagine if there was a reliable 7-day period, occurring like clockwork every single year, where the stock market has historically shown an overwhelming bias to move upwards. It sounds almost too good to be true, right? In the world of finance, we are taught that markets are highly efficient, that free lunches do not exist, and that trying to time the market is a fool's errand. Yet, for decades, professional traders and casual investors alike have whispered about a seasonal phenomenon that seems to defy the standard rules of economics. Today, we are going to strip away the myths, bypass the hype, and put this legendary end-of-year market phenomenon to the ultimate test. We are not here to give you empty promises or tell you about a magic money machine. Instead, we are going to look at the hard, cold historical data to see if this year-end anomaly is a genuine edge you can trade or just a statistical coincidence wrapped in holiday packaging. This fascinating market phenomenon is widely known as the Santa Claus Rally. First officially identified and named by the legendary market analyst Classical Technical Analysis in 1972, this concept has become a cornerstone of seasonal trading strategies. But what exactly is the Santa Claus Rally? Unlike general seasonal trends that might span weeks or months, this strategy has a highly precise and strict definition. It refers specifically to the last 5 trading days of the current calendar year and the first 2 trading days of the new year. That is a total of just 7 trading days. The theory suggests that during this brief period, stock prices have a strong tendency to rise. But why would the market behave this way? Market historians and economists point to several potential driving forces. First, there is tax loss harvesting, where institutional investors sell off losing positions earlier in December and then reinvest that cash back into the market. Second, there is a general sense of holiday optimism among retail investors, combined with year-end bonuses being put to work. Finally, many institutional traders and short sellers have already closed their books and gone on vacation, leaving the market with lower volume and less downward pressure. Over the decades, classical technical analysis's discovery has transitioned from a quirky calendar observation into a highly anticipated event on Wall Street, with traders closely watching these 7 days as a barometer for the year ahead. The historical significance of this period cannot be overstated. In the Stock Trader's Almanac, classical technical analysis famously wrote a phrase that has been repeated on trading floors for generations. If Santa should fail to call, bears may come to Broad and Wall. Broad and Wall, of course, refers to the location of the New York Stock Exchange. This means that when the market fails to rally during these specific 7 days, it is historically seen as a severe warning sign that a bear market or a major correction might be lurking around the corner in the upcoming year. For example, the failure of the market to rise during this period in late 1999 and early 2000 preceded the devastating dot-com crash. Similarly, the absence of a year-end rise in late 2007 predated the great financial crisis of 2008. This dual nature of the pattern, acting both as a short-term trading opportunity and a long-term macroeconomic warning light, is what makes it one of the most studied seasonal anomalies in financial history. But as systematic traders, we cannot rely on old Wall Street adages or cherry-picked historical examples. We need to see how this pattern actually behaves under strict, rule-based backtesting conditions. To find out if this pattern still holds its edge in the modern era, we designed a rigorous backtest. We chose the SPY, which tracks the S&P 500 index, as our primary trading instrument. The S&P 500 is the ultimate benchmark for the U.S. stock market, representing the 500 largest publicly traded companies, making it the perfect vehicle to test a broad market anomaly. Our backtesting window spans a full decade, from August 4th, 2016 to August 4th, 2026, covering 10 years of market action. This period is particularly interesting because it includes a wide variety of market environments. The steady bull market of the late 2010s, the extreme volatility of the 2020 pandemic crash, the high inflation bear market of 2022, and the subsequent technology-driven recovery. The trading rules for our Santa Claus rally backtest are simple, objective, and completely free of curve fitting. We enter a long position in SPY at the market close on the 5th to last trading day of December. We then hold this position through the holidays, without any stop losses or profit targets, and exit the trade at the market close on the second trading day of January. This ensures we capture the exact 7-day window, with zero discretionary decisions. Executing a strategy like this requires a deep understanding of market mechanics during the holiday season. When you trade the last 5 days of the year and the first 2 days of the new year, you are operating in a very unique environment. Trading volume is typically much lower than average, which can lead to wider bid-ask spreads and sudden, sharp movements on low liquidity. Some traders might look at this and think it is too risky to hold a position with no stop loss over the Christmas and New Year holidays, especially when global news doesn't stop just because the exchange is closed. However, the core thesis of the Santa Claus rally is that the institutional absence and festive retail buying create a structural upward drift that overcomes these short-term risks. In our backtest, we did not apply any technical indicators like moving averages, RSI, or ATR trailing stops. We wanted to isolate the pure, unadulterated seasonal effect. By keeping the execution rules incredibly simple, we can determine if the calendar itself acts as a reliable edge, or if we are just chasing statistical noise that disappears when subjected to transaction costs. Now, let's look at the actual numbers generated by our backtest over this 10-year period. Over the entire duration, the strategy executed a total of 10 trades. Because this is a strictly seasonal strategy that only triggers once a year, the number of trades matches the number of years we tested. Out of these 10 trades, the win rate was 30%. A win rate of this level is highly impressive, especially for a strategy with a fixed holding period and no active trade management. But win rate alone does not tell the full story. We also need to look at the magnitude of the returns. Over the course of the backtest, the total cumulative return of the Santa Claus rally reached plus 21.2%. During the exact same period, a traditional buy-and-hold strategy on the SPY generated a total return of plus 311.0%. At first glance, you might notice a significant difference between these two figures, but we must remember that our seasonal strategy was only exposed to the market for a total of 70 trading days over the entire 10-year period, while the buy-and-hold strategy was exposed to the market for thousands of days. To put these returns into a clearer perspective, let's compare the annualized performance and efficiency of both approaches. The compound annual growth rate, or CAGR, for our seasonal strategy was plus 1.9%, whereas the buy-and-hold strategy achieved a CAGR of plus 15.2%. Now, you might look at these annualized numbers and think that buying and holding the index is the obvious choice because of its higher absolute return. However, as systematic backtesters, we must look at capital efficiency and risk-adjusted returns. The buy-and-hold strategy requires you to keep 100% of your capital locked in the market for 10 full years, exposing you to every single overnight risk, geopolitical crisis, and market crash. In contrast, the Santa Claus rally only deployed capital for about 7 days per year. This means for the remaining 358 days of the year, your capital was completely safe, sitting in cash, or earning risk-free interest in short-term treasury bills. When you analyze the return relative to the time spent in the market, the efficiency of this seasonal pattern becomes highly apparent, demonstrating a massive outperformance on a time-weighted basis. Of course, no trading strategy is perfect, and we must always examine the downside. Risk management is what separates professional traders from gamblers. Let's look at the maximum drawdown, which measures the largest peak-to-trough decline in our account equity. During this 10-year backtest, the Santa Claus rally experienced a maximum drawdown of -3.7%. In comparison, the buy-and-hold strategy on the SPY went through much deeper and more painful drawdowns during market corrections, forcing investors to sit through stomach-churning losses for months or even years before recovering. However, a drawdown in our seasonal strategy, even if smaller in absolute percentage, can be psychologically challenging because you only have one trade per year to make up for a loss. If the trade fails, you have to wait an entire calendar year to try again. Furthermore, we must address the historical warning sign. In the years where this strategy failed to produce a positive return, the broader market often experienced a highly volatile or bearish year. This confirms that monitoring the outcome of these 7 days remains an incredibly valuable macro indicator for your overall portfolio allocation. While the results of this backtest are highly intriguing, it is crucial to discuss the practical limitations and nuances of trading the Santa Claus rally in the real world. First and foremost is the issue of opportunity cost. Because this strategy only actively trades for 7 days a year, you cannot rely on it as a standalone wealth-building system. Your capital must be productively deployed elsewhere during the other 11 months of the year. This strategy is best utilized as a tactical overlay, an extra seasonal boost that you add to an existing, diversified portfolio. Second, we must consider transaction costs and slippage. Because trading volume is thin during the holidays, executing large orders at the exact market close can sometimes result in unfavorable pricing, which can eat into the relatively small percentage gains of this strategy. Finally, there is the psychological barrier. It takes discipline to execute a trade right before the holidays when most people are switching off their brains, and it takes even more discipline to accept that some years will simply result in a loss, without trying to tinker with the rules. In conclusion, our 10-year backtest of the Santa Claus rally on the SPY from 2016 to 2026 confirms that this legendary Wall Street seasonal pattern is far more than just a holiday myth. It represents a statistically robust anomaly that has continued to deliver high win rates and highly efficient risk-adjusted returns, even in a modern, highly computerized market environment. However, it is not a magical shortcut to riches, and it should never be traded blindly without understanding its place in a broader, comprehensive portfolio strategy. Here at Backtested Hub, our mission is to bring you the unbiased, data-driven truth about classic trading strategies, helping you separate marketing hype from verifiable historical reality. If you found this deep dive into market seasonality valuable, please hit the like button, subscribe to the channel, and turn on notifications so you never miss our upcoming backtests. We want to hear from you. Have you ever traded this end-of-year pattern, or do you prefer to stay in cash during the holidays? Let us know your thoughts and experiences in the comments below, and we will see you in the next video.